The markets are closed. The ticker tape has stopped. For the first time in days, the price of silver is not moving. It is frozen at $71.91. Most investors look at this stillness and feel relief. They think the war is over for the week. They think they can relax, drink some eggnog, and wait for January. But the professional trader knows better. This silence is not safety. It is the calm before the most unpredictable storm of the year. We are about to enter a period known on Wall Street as the Ghost Week. It is the 7 days between Christmas and New Year's Day. It is a time when the senior risk managers, the hedge fund titans, and the central bankers leave the building. They go to Aspen, they go to St. Bart's, and they leave the multi-trillion-dollar financial system in the hands of algorithms and junior traders. This creates a dangerous environment. It creates a liquidity vacuum. In a normal market, it takes billions of dollars to move the price of silver by $1. During Ghost Week, it might only take a few million. In this urgent holiday update, I'm going to explain why the next 7 days could see the most violent volatility of the entire year. I'm going to show you why holding $71.91 going into this vacuum is both a victory and a risk. And I am going to give you the survival guide for trading when the lights go out on Wall Street. The adults have left the room. The machines are in charge. Let's talk about the Ghost Week. First, let's analyze the close. We finished the week at $71.91. We are up over $1 on the day. We are up significantly on the week. Technically, this is a masterpiece. We held the breakout. We didn't crash back to $65, but notice the price action in the final hours. We pulled back from the high of $72.42. Why? Because traders were squaring up. Nobody wants to be a hero on Christmas Eve. The smart money took some chips off the table. They sold a little bit to pay for the holidays. This is normal. It is healthy. However, it leaves us in a precarious position. We are hovering just below the all-time highs. When you are at the top of the mountain, the air is thin. It doesn't take much of a push to send you sliding back down or to send you flying higher into the stratosphere. The market is coiled. It has stored energy. And starting tomorrow morning, when the futures market reopens for a half-day session, that energy has to go somewhere. But there are no humans left to guide it. I want you to visualize a trading floor at JP Morgan or Goldman Sachs right now. Usually, it is a hive of activity. Hundreds of people, shouting, phones ringing. But tomorrow morning, it will be a ghost town. There will be maybe 3 people sitting at a desk that usually holds 50. This is the skeleton crew. These are the junior employees, the interns, the guys who drew the short straw. They have very strict instructions from their bosses. Do not take risks. Do not make big bets. Just keep the lights on until January. This sounds boring, but it is actually dangerous. Why? Because if news breaks, if a headline comes out about the Middle East or about a mine strike in Mexico, the skeleton crew does not have the authority to step in and stabilize the market. They don't have the authorization to deploy capital to absorb a shock. So if a big sell order hits the market, the junior trader steps aside. He lets the price crash. If a big buy order hits, he steps aside. He lets the price spike. This removes the shock absorbers from the market. The market makers, who usually smooth out the volatility, are gone. This means we could see flash crashes or flash rallies that have no fundamental reason. We could see silver drop $5 in a minute and then recover 5 minutes later. It is the Wild West. With the humans gone, who is left? The robots. High-frequency trading algorithms do not take holidays. They do not celebrate Christmas. They run 24/7. In a normal market, human judgment balances out the algorithms. But during Ghost Week, the algorithms are the only game in town, and algorithms feed on volatility. If the price starts to drop, the algorithms sense the momentum and they short. This pushes the price down faster, which triggers more algorithms to short. Without a human to say, this is stupid, the price is too low. The cascade continues until it hits a mathematical floor. The same happens to the upside. If silver breaks $72 tomorrow, the bots will chase it. They will trigger a melt-up. We could see silver hit $75 or $80 on absolutely zero volume. This is why technical analysis during Ghost Week is unreliable. Support and resistance levels are like tissue paper. The machines will rip right through them because there is no liquidity to defend the lines. There's another danger you need to know about: the spread. The spread is the difference between the bid and the ask. In a liquid market, the spread is 1 cent. In Ghost Week, the spread can widen to 20 cents, 50 cents, or even $1. Why? Because the market makers are gone. The few people willing to take the other side of your trade demand a massive premium for the risk. This means if you try to trade, you get ripped off. If you hit market buy, you might pay $73 when the price is $72. If you hit market sell, you might get filled at $70. You lose money just entering and exiting the room. This is why the #1 rule of Ghost Week is: do not trade. Do not use leverage. Do not try to scalp the market. You're playing poker against a machine that can see your cards, in a casino where the dealer takes a massive cut of every hand. For the long-term investor holding physical silver, this doesn't matter. The value of your ounce doesn't change because the spread widens. But for the person watching the screen, it is terrifying. You will see price swings that make no sense. You must ignore them. So, the humans are gone. The robots are in charge. The spreads are wide. This creates a phenomenon called the liquidity vacuum. In part 2, we are going to dive deeper into this mechanic. We are going to look at historic examples of holiday crashes and holiday rallies. We are going to analyze the thin order book and show you visually why a small order can move the price so much. And we are going to discuss the Santa Claus Rally. Despite the danger, this week is statistically bullish. Why? Because with no sellers at the desk, prices tend to drift higher. We will look at the probability of silver hitting $75 before New Year's Eve, simply because gravity has been turned off. The market is empty, but the opportunity is full. It is Christmas Day. The markets are closed. The price of silver is locked at $71.91. It feels peaceful. It feels safe. But in part 1, we explained why this piece is an illusion. We are entering Ghost Week, the 7 days where the senior traders leave and the algorithms take over. We talked about the skeleton crew and the danger of automated trading. Now, we need to talk about the physics of the market itself. We need to talk about liquidity. Liquidity is like the ice on a frozen lake. When the ice is thick, you can drive a truck on it. You can sell $1 billion of silver and the price barely moves. But during Ghost Week, the ice gets very, very thin. If you step too hard, you fall through. In part 2, we are going to visualize the liquidity vacuum. I'm going to show you exactly what an empty order book looks like, and why a single buy order tomorrow morning could send silver to $75 in seconds. We are going to look at the Santa Claus Rally phenomenon, why markets tend to drift higher when the short sellers are on vacation. And we are going to look at the physical freeze happening at the coin shops right now. The price is high, the ice is thin. Let's see what happens when we step on it. To understand volatility, you have to look under the hood of the COMEX. You have to look at the order book. Imagine a ladder. On one side, you have people waiting to buy. I will buy at $71. On the other side, you have people waiting to sell. I will sell at $72. In a normal week, there are thousands of orders on every rung of that ladder. If a big buyer comes in, they have to climb the ladder slowly. They chew through the orders one by one. The price moves smoothly. But tomorrow, the ladder will be missing rungs. There might be a seller at $72, and then nobody until $72.50, and then nobody until $73. This creates air pockets. If a hedge fund algorithm decides to buy silver tomorrow morning, it buys the contracts at $72. Then it instantly jumps to $72.50. Then it instantly jumps to $73. The price doesn't climb. It teleports. It creates a gap on the chart because there was nobody there to trade the prices in between. This is the liquidity vacuum. It amplifies every move. A $10 million order, which is tiny in the grand scheme of things, can act like a $1 billion order. This works both ways. If bad news breaks, the price can teleport down. But right now, the momentum is up. The path of least resistance is higher. So the vacuum is pulling us toward the sky. There is a statistical anomaly that happens this week. It is called the Santa Claus Rally. Historically, the stock market and the precious metals market tend to rise during the last 5 trading days of the year and the first 2 days of the new year. Why does this happen? Is it magic? No, it is the absence of short sellers. Think about the psychology of a short seller. They are betting the price will fall. They are fighting the trend. It is a stressful job. Do they want to fight the trend on December 26th? Do they want to stare at a screen while their family is opening presents? No. So the short sellers close their positions before Christmas. They flatten the book. When you remove the sellers from the market, what is left? Only the buyers, only the passive inflows from pension funds, only the long-term holders. This creates a phenomenon called the drift. Without the heavy hand of the banks smashing the price down, the market naturally floats upward, like a balloon that has been untethered. It isn't an explosion. It is a gentle, relentless rise. 71.91, 72.10, 72.30. It just keeps going up because there is nobody there to hit the sell button. This drift is powerful. It can push silver through major resistance levels without any news at all. We could wake up on New Year's Eve and find silver at $75 simply because the bears went on vacation. However, I must give you the warning. Thin markets are fragile. While the drift is bullish, the vacuum is dangerous. We have seen flash crashes happen during this week in the past. Sometimes a fat finger error occurs. A trader types sell 1,000 instead of sell 100. In a thin market, that error crashes the price by $2 in a second, or a predatory algorithm senses weakness and attacks. If you are using leverage, if you have a stop-loss order in the system, you are a target. A flash crash can dip the price down, trigger your stop-loss. Sell your position at the bottom and then bounce back to the highs in 5 minutes. You lose everything. The price ends up unchanged. This is why I told you in part 1, do not trade. Do not put stop losses in the system during Ghost Week. The machines will hunt them. If you hold physical metal, a flash crash is irrelevant. It is just a glitch on a screen. But if you are trading paper, it is a death sentence. Now let's look at the physical market. We talked about the dealer shutdown in the last series. But today, on Christmas Day, the shutdown is total. I checked the websites of the 5 biggest bullion dealers in the US this morning. They are technically open. The website works. But look at the pricing. The premiums have expanded again. To buy a Silver Eagle today, you are paying nearly $90. Why? Because the dealers are terrified of the gap up we talked about. They know that when the markets open tomorrow, silver could be $75. They don't want to sell to you at today's price, so they jack up the premium to protect themselves. They are effectively saying, go away. We don't want your business until January. This confirms the shortage. In a normal market, dealers fight for your business. They lower prices. In a shortage, dealers hide from you. They raise prices. This means the real price of silver is not $71.91. It is whatever you have to pay to get it. And right now that number is getting closer to 3 digits. So the order book is hollow. The shorts are gone. The dealers are hiding. We are drifting toward the new year. But what happens when the clock strikes midnight on December 31st? We enter January, and January is not a ghost week. It is a tsunami. In part 3, we are going to look at the January effect. I am going to explain why billions of dollars of new capital are waiting on the sidelines to enter the market on January 2nd. We are going to look at the pension fund allocations, and we are going to calculate what happens when huge institutional buying hits a market that has been thinned out by the holidays. The drift is nice, but the explosion comes next month. We are currently floating in the vacuum between Christmas and New Year's Day. The price of silver is holding at $71.91. The trading desks are empty, the volume is low, the danger is high. But while the market sleeps, the calendar is ticking. In less than 7 days, the year 2025 will end, and the year 2026 will begin. To the average person, this is just a change of date. But to the financial system, January 1st is not just a date, it is a reset button. Trillions of dollars of capital are currently sitting on the sidelines, waiting for the starting gun of the new year to be fired. In part 3, we are going to look at the January effect. I'm going to explain why the first week of January is historically the most explosive week for precious metals. We are going to look at the great rebalancing, where pension funds and hedge funds are forced by their own rules to buy the best performing asset of the previous year. And that asset is silver. The ghost week is the calm. January is the tsunami. Let's follow the money. To understand what happens next week, you have to think like a portfolio manager. Imagine you manage a $10 billion pension fund. Your mandate is to keep a balanced portfolio, 60% stocks, 40% bonds, maybe 5% commodities. In 2025, the stock market was volatile. Bonds got crushed by inflation. But silver? Silver went vertical. It broke $50. It broke $60. It is now at $71. Silver was the asset of the year. Now look at your portfolio. Because silver went up so much and bonds went down, your allocation is out of whack. Or more likely, you own 0 silver. You missed the entire move. And now your clients are going to look at your year-end report and ask, why didn't we own the best performing asset on earth? This creates career risk. If you don't buy silver in January and it keeps going up, you get fired. So what happens on January 2nd, the first trading day of the year? These fund managers place massive buy orders. They have to reweight their portfolios. They have to chase the winner to prove they are smart. This is not speculation. It is mandated buying. Their investment charter requires them to allocate capital. And when billions of dollars of institutional money tries to squeeze into a tiny silver market, the price doesn't just rise, it skips. Let's talk about scale. The global pension market is roughly $50 trillion. Historically, pension funds own almost 0 gold or silver. They own paper. But with inflation sticking and bonds failing, they are starting to pivot. If global pension funds decide to allocate just 0.1% of their capital to silver, that is $50 billion. 50 billion. The entire annual mine supply of silver is worth about $25 billion. So if the pension funds move just a fraction of their money, they need to buy 2 years' worth of global production. There isn't enough silver. It doesn't exist. So what happens? The price has to rise until that $50 billion can only buy a small amount of metal. The price acts as a rationing mechanism. To fit the elephant of pension money into the mouse hole of the silver market, silver has to be $200 or $300. We are seeing the early signs of this rotation now. The Ghost Week drift is the smart money front-running the pension money. They know the elephant is coming. This rotation is being driven by the death of the 60/40 portfolio. For 40 years, you just bought stocks and bonds. It worked. But in an inflationary world, stocks and bonds fall together. They stop protecting you. Institutions are desperate for a non-correlated asset, something that goes up when the system goes down. They tried crypto. It is too volatile for many pensions. They tried real estate. It is illiquid. That leaves commodities. And within commodities, silver is the only one that is both strategic and monetary. It is the perfect hedge. So, in 2026, we are going to see a structural shift. Asset allocators are going to create a permanent slice of the pie for strategic metals. This means the buying we see in January won't be a one-time trade. It will be a persistent bid. Every month, when payroll deductions come in, the pension funds will buy more silver, month after month, year after year. This removes the volatility. It creates a floor that rises forever. Right now, during Ghost Week, volume is low. We talked about the vacuum. But on January 2nd, the volume comes back. The mainframes turn on. The high-frequency traders return. The bank desks open. When this massive volume hits the market, it will meet a supply shortage. Remember the dealer freeze? Remember the empty vaults? We are going to see high volume plus high price. This is the most bullish technical signal in existence. It means the rally is supported by mass participation. The drift of Ghost Week might take us to $73 or $74, but the volume of January could push us through $80 in a week. We are building potential energy. The dam is holding back a river of liquidity. And the dam breaks next week. So the funds are coming. The allocations are changing. The volume is returning. We are looking at a setup for 2026 that is historic. But what does the rest of the year look like? Is this a straight lineup, or will the empire strike back? In part 4, the conclusion of this holiday series, I'm going to give you the outlook for 2026. I'm going to map out the major events we need to watch. The debt ceiling, the BRICS summit, the solar production numbers. And I'm going to leave you with the final strategy for holding through what promises to be the most volatile year of our lives. The Ghost Week is almost over. The real game is about to begin. We have navigated the silence of the Christmas close. We have analyzed the dangers of the Ghost Week liquidity vacuum. We have mapped out the massive wave of capital preparing to strike in the January effect. Now we must lift our eyes from the daily chart and look at the horizon. The year 2025 is effectively over. It was the year the breakout began. It was the year the $65 wall fell. But 2026 is going to be the year the system breaks. In this final chapter, part 4, I'm going to give you the strategic outlook for 2026. I'm going to show you the 3 massive macro events that are scheduled to hit the market in quarter 1. The debt ceiling, the BRICS currency launch, the solar production mandates. And I'm going to leave you with the final psychological armor you need. Because while the price is going to $100, the ride will try to throw you off. You have the winning lottery ticket. Now you just have to hold on to it until the drawing. Let's finish this. The first major catalyst of 2026 is already baked into the cake. The United States debt ceiling. Washington pushed the problem into the future. Well, the future is here. In early 2026, the U.S. Treasury runs out of cash. We have seen this movie before. The politicians will fight. They will threaten default. They will shut down the government. And then, at the last second, they will print more money. But this time is different, because this time, the debt is exponentially higher. And the interest on the debt is consuming the entire tax revenue of the country. When the debt ceiling fight heats up in February or March, the credit rating agencies will threaten a downgrade. The bond market will panic. And where does capital flee when bonds are scary? It flees to hard assets. Silver acts as the ultimate credit default swap against the U.S. government. Every time they raise the debt ceiling, they dilute the dollar. Every time they dilute the dollar, the price of silver in dollars must rise mathematically to maintain its value. So expect a fear trade to layer on top of the industrial trade in Q1. We will have Samsung buying silver for batteries. And we will have hedge funds buying silver because they are terrified of U.S. treasuries. That is a dual turbo engine for the price. Later in the year, we have the BRICS summit. Brazil, Russia, India, China, South Africa, and their new members. For 2 years, they have been teasing a new trade settlement unit. A currency backed by gold and commodities. Rumors are swirling that 2026 is the launch year. If they announce a currency that is partially backed by gold, it instantly remonetizes silver. Why? Because silver and gold are bonded by history. If gold becomes money again, silver rides the coattails. China knows this. That is why they are hoarding. They want to be holding the physical collateral when the announcement is made. This event hangs over the market like a sword of Damocles. The short sellers know it is coming. They know that on any given Sunday, a press conference in Beijing could gap the price of silver to $100 instantly. This creates a floor of fear. No bank wants to be aggressively short silver in 2026 because the geopolitical risk is too high. This means the short covering we saw this week will continue. The banks are de-risking, and de-risking means buying. And then there's the industry. We talked about the Samsung bomb, but we haven't talked about the new solar mandates. The European Union and the United States have set aggressive targets for 2030. To hit those targets, solar installation must double in 2026 compared to 2024. Double the panels, double the silver, but the mines haven't doubled. The mines are flat. This is the math of extinction we discussed in our deep dive. In 2026, we will hit the wall. We will see the first major solar factory shut down because they cannot source silver paste. When that headline hits, solar giant halts production due to silver shortage. That is the moment silver leaves the atmosphere. It goes from being a precious metal to a critical strategic material. Governments will panic. They will hoard. They will ban exports. We are not speculating on if this will happen. We are watching it happen in slow motion. The supply chain is snapping. So what do? The price is $71.91. The year is ending. The crisis is building. Your strategy for 2026 is simple. Accumulate and sit. Do not try to trade the swings. You are going to see days where silver drops $5. The banks will try to shake you out. The media will call it a bubble. Ignore them. You have the data. You know the vaults are empty. You know the debt is unpayable. You know the industry is desperate. The only way you lose is if you sell too early. The only way you lose is if you let them scare you out of your position before the real repricing happens. If you have cash, buy the dips. If you have silver, lock the safe. Treat your silver like a family heirloom. Do not look at the dollar value. Look at the ounce count. The goal is to cross the finish line with as many ounces as possible. So here's the verdict for the Ghost Week. We survived. We held the highs. We are entering the new year from a position of strength. The price at $71.91 is a victory. It proves that the buyers are stronger than the banks. It proves that the physical market is dictating the terms. Enjoy your holiday. Rest up. Because when January 2nd hits, the volume returns, the pension funds arrive, the industry panics, and the rocket launches for the next leg. You are early, you are right, you are ready. Welcome to the year of silver. Subscribe.